Hi, we are from Group 5. I'm Isihan, metric number 310324. I would like to start by talking about introduction. Sunbite Foods in Berhad is a food manufacturing company producing healthy snacks, ready-to-eat meals, and premium packaged foods. In 2025, the company sold 60,000 units of the product with sales worth 1,200,000 ringgit. The company hired sales agent to market the product. Currently, the sales agent receives a 50% commission on each sale. The statement of profit or loss and other comprehensive income of the year ended 31st December 2025 is as follows. For the year of 2025, the business target to achieve a net income to sales ratio of 30%. Net income is divided by sales. Therefore, a few different plans need to be considered. For question 1, we will discuss more about the calculations of CVP analysis. The first calculation was sales price per unit of the product. The formula is total sales divided by unit sales, which is 1,200,000 ringgit divided by 60,000 units equals to 20 ringgit per unit. Second calculation is for the total variable cost. The formula is variable cost of goods sold plus sales commission, which is 600,000 ringgit plus 180,000 ringgit equals to 780,000 ringgit. The third calculation will be variable cost per unit. The formula is total variable cost divided by unit sold, which is 780,000 ringgit divided by 60,000 units. The variable cost per unit is 30 ringgit. For the fourth calculation is total fixed cost. The formula is the sum of all the fixed costs. For this question, it will be fixed COGS plus fixed advertising expenses plus rental expenses plus administrative salaries expenses plus insurance expenses. The total fixed cost for this question will be equal to 252,000 ringgit. The fifth calculation will be contribution margin per unit. The formula is sales price per unit of the product, which is 20 ringgit minus variable cost per unit, which is 30 ringgit, equals to 7 ringgit per unit for the contribution margin. The sixth calculation will be contribution margin ratio. The formula is contribution margin per unit we calculate just now, which is 7 ringgit divided by selling price per unit, 20 ringgit, and multiplied by 100 equals to 35% for the contribution margin ratio. The seventh calculation will be break-even point BEP in unit. The formula is fixed cost divided by contribution margin per unit, which is 252,000 ringgit divided by 7 ringgit. The BEP in unit is 36,000 units. The last part of the question 1 is break-even point in amount, RM. The formula for BEP in amount is sales price per unit multiply BEP unit, which is 20 ringgit multiply 36,000 units equals to 720,000 ringgit.
My name is A251. My matrix number is 310370. So I'll be talking about question 2. Identify the units of product that needed to be sold by the company in order to obtain a net income to sales ratio of 30% in 2025. Describe possible actions that should be taken by the company to achieve the target. So first we will find units needed, which is Q equals to fixed cost plus sales price times Q times 0.3, which is the 30% in net income to sales ratio over contribution margin per unit. Fixed cost is 252,000 plus sales price, which is 20 ringgit per unit, times Q, unknown, times 0.3, which is the 30% over 7 ringgit contribution margin per unit. So, and then we will find 7Q equals to 252,000 plus 6Q, and then we'll move Q to the left side, and then finally we'll get Q equals to 252,000 units. So 252,000 units of product is needed to be sold by the company in order to obtain a net income to sales ratio of 30%. Next is the possible actions to be taken by the company to achieve the target. So first, they can increase the selling price. By increasing the selling price, the contribution margin per unit will also increases, and which will contribute more towards covering the fixed costs and generating profit, reducing the total units required to hit the 30% goal. Secondly, is reduce variable costs, which means that lower raw material cost will increase the contribution margin per unit as well, and then each sales will contribute more towards covering the fixed cost and also increase the company's profit.
My name is Suja En. My matrix number is 310650. Now I will present for question 3, which is about determining the required selling price per unit in order for the company to achieve a net income of 30% of sales. The main objective of this question is to find out how much the company needs to charge per unit, assuming that the company continue to sell 60,000 units and that all the costs remain unchanged. First, I will explain the cost structure of the company. The total fixed cost is given as 252,000. To calculate the fixed cost per unit, we divide the total fixed cost by the number of units sold. So, 252,000 divided by 60,000 units gives a fixed cost per unit of 4.2 ringgit. Next, the variable cost per unit is 13 ringgit. To obtain the total cost per unit, we add the variable cost per unit and the fixed cost per unit. So, 13 ringgit plus 4.2 ringgit equals to 17.2 ringgit per unit. This amount represents the total cost incurred by the company for each unit sold. After determining the total cost per unit, the next step is to calculate the required selling price. The question states that the company wants to earn a net income equal to 13% of sales. This means that 70% of sales will cover total cost, while the remaining 30% represent the profit. So, to calculate the required selling price, the formula is selling price is equal to the total cost per unit divided by 1 minus the target net income ratio. By substituting the values into the formula, we get 17.2 divided by 1 minus 0.3. After calculation, the required selling price is 24.57 per unit. So, in conclusion, in order to achieve a 30% net income to sales ratio, the company must increase its selling price per unit from 20 ringgit to 24.57 ringgit. This represents an increase of 4.57 per unit.
Now, I will explain question 4. If the company plans to improve the quality of the product over the next year, suppose the improvement will increase the cost of goods sold, variable cost to 55% per unit sales instead of at 50% at the current level. Fixed advertising expenses is also expected to increase by 4,000 ringgit due to an advertising campaign plan to boost sales. It is expected that the product improvement combined with higher advertising expenses will increase sales by 200%. Discuss whether the company has the possibility to proceed with the plan. Variable cost of goods sold 55% times sales price equals to 0.55 times 20 ringgit equals to 11 ringgit. Variable commission 50% times 20 ringgit equals to 3 ringgit, and the new total variable cost per unit is 11 ringgit plus 3 ringgit equals to 40 ringgit. New fixed cost 252,000 ringgit plus 4,000 ringgit equals to 356,000 ringgit. And the new sales volume is 60,000 units times 300%, that is increased by 200% equals to 180,000 units. Now total revenue 180,000 units times 20 ringgit equals to 3,600,000 ringgit. Total variable cost is 180,000 units times 40 ringgit equals to 2,520,000 ringgit. Contribution margin is 1,080,000 ringgit. And fixed cost is 256,000 ringgit. So, we calculate the new profit, which is the total revenue minus the total cost, which is the variable and fixed cost. New profit is 3,600,000 ringgit minus 2,776,000 ringgit equals to 824,000 ringgit. The company should proceed. The net income increases significantly from 168,000 ringgit to 824,000 ringgit.
The question stated that the company is faced with their sales agent asking for an increasement in commission to 20%. The CEO of the company want to investigate the possibility of them hiring new sales staff to replace the original network of sales agent. The company is expected to bear any additional costs to this decision. The company will have to hire 6 sales agents to cover the current market area. The fixed salary of each sales agent is 1,000 ringgit per month. In addition to that fixed salary, they will be earning commission in the rate of 5% on all sales. We need to advise this company whether or not they should approve the request of their sales agent or rehiring 6 more sales agents for a lower commission. We also need to justify our answer by giving calculation. Now let us calculate the net income when the company approved the increasement of commission rate to 20%. Originally, the selling price per unit is 20 ringgit. If the commission is involved, a 14 ringgit of variable cost would be charged. 20 minus 14 would lead us to a contribution margin of 6 ringgit. With the sales unit of 60,000, we will get 360,000 ringgit for the contribution margin. We also have the fixed cost of 252,000, which leads us to the net income of 108,000. If the company decided to hiring their own sales agent, the variable cost would become 11 ringgit. 20 minus 11, that leads us to 9 ringgit of contribution margin per unit. So with the sales unit of 60,000, that would give us 540,000 ringgit of contribution margin. The fixed cost, which is the salary that we pay to our sales agent annually, is 324,000 ringgit. So deducted that, we will get a net income of 260,000 ringgit per annual. Compare the two decisions of approving the request of increasement in commission and hiring our own staff. Originally, we will only get 108,000 of net income if we approve the commission request. However, we would get 216,000 if we hiring our new sales staff. That means if we hire our own sales staff, we would get 108,000 ringgit more in the net income. In conclusion, the final decision of the company should be hiring the 6 new sales agents enabled to achieve a higher net income and profit for the company.
Now I will present for question 6. Provide the management of the company with recommendation for the best strategies to be implemented in 2025 in order to boost the company's performance and increase its competitiveness in the market. The first strategy is strengthening cost control and efficiency. The company should focus on reducing both variable and fixed costs to improve profitability. Variable costs can be reduced by improving production efficiency, minimizing waste, and negotiating better deals with suppliers. Optimizing sales-related expenses such as advertising and commissions can also help lower costs without affecting revenue. Fixed costs can be managed by streamlining administrative tasks and investing in long-term initiatives such as energy-saving measures or technology upgrades. By controlling costs effectively, the contribution margin per unit increase, which means that each sale contributes more to covering fixed costs and generating profit. This also allows the company to maintain flexibility in pricing decision and avoid relying on increasing price to achieve the targets. The second strategy is increasing sales volume through market expansion. Higher sales volume reduce fixed costs per unit and increase total contribution, leading to greater overall profit. The company can achieve this by targeting new customer segments, entering new geography areas, and expanding distribution channels to make the product more accessible. Effective marketing campaigns, both online and offline, can attract new customers and increase brand visibility. Increasing sales volume not only spread fixed costs over more units, but also can strengthen the company's competitive position in the market. It allows the company to maintain a competitive pricing while improving profitability and market share.
For the third recommendation that can be implemented by the company in order to boost the company's performance and increase its competitiveness in the market is by providing products quality. First is real-time feedback loop, which is a company can use AI to analyze the customers' reviews instantly and fix the product's flaw before they are scaled. Next is focus on sustainability. So, company can improve the build quality and also eco-transparency as 2025 consumers prioritize green and also durable goods. And the fourth recommendation is establish strategic partnership. First, we have collaborate with suppliers. So, company can partner with reliable suppliers to help secure a better pricing, consistent quality, and stable supply. And secondly is expand the market access. Now, company can have strategic partnership, which will allow the company to enter a new geographic or customer markets more quickly. And next, we have share resources and reduce risk. By sharing resources such as technology, expertise, and or infrastructure, will help lowering the operating cost. And partnerships can help distributing the financial and operational risk across multiple parties.
As a conclusion, through cost volume profit CPV analysis, Sunbite Foods Sdn Bhd can make informed decisions on pricing, cost management, and strategy change to achieve 2025 goals. Implementation of these strategies will enhance its profitability and market competitiveness.